Welcome to Penny Street Journal, the channel designed to simplify investments. Feeling lost in financial jargon? You're in the right place. Today we're going to break down investment types, goals, risk management, and how to save on costs and fees. So let's dive in. Today we're venturing into the world of investments, and we'll start with the most fundamental step: understanding different types of investments. You can think of investment types as different vehicles, each with its purpose, speed, and risk level. Stocks. If investing were a race, stocks would be the sports cars. They offer high speed, but come with risks. When you buy a stock, you're purchasing a small part of a company. If the company does well, your stock can grow significantly. For example, if you had invested $1,000 in Company A 5 years ago, today it might be worth $2,000 or more. But it could also go the other way, where the value drops. It's thrilling, but requires a solid understanding of the market. Now, let's switch gears to bonds. Think of them as the dependable family sedans of investments. You're lending your money to a government or company, and they pay you interest. It's generally safer, but offers lower returns. Let's say you bought a government bond for $1,000 with a 2% annual interest rate. Every year, you'd receive $20, and at the end of the bond's term, you'd get your $1,000 back. It's a steady and more secure way to grow your money, especially for short-term goals. Mutual funds. Finally, imagine mutual funds as a tour bus driven by a professional. You're pooling your money with other investors, and a fund manager picks stocks and bonds for the group. It's like having a professional chef prepare a diverse meal for you. They pick the ingredients, stocks and bonds, and manage it for you. If one ingredient fails, the others might still succeed, spreading the risk. ETFs. It's like a fruit basket. Instead of picking individual fruits, you get a tasty variety in one package. More control, more flexibility, often lower fees. Here is a pro tip. If you're a beginner, it may be wise to start with ETFs, where professionals manage your investments. It's like learning to drive with an instructor, but cheaper. Look for lower fees and a solid track record. It can be a cost-effective way to diversify. Real estate. It's not just houses and commercial buildings. Real estate investment trusts, REITs, let you invest without owning physical property. Think of it like owning a garden, either the land or just the fruits it produces. Each has benefits and responsibilities. Pro tip on real estate: location and market timing matter. Consider your long-term goals and risk tolerance. Cryptocurrency. Beyond Bitcoin and Ethereum, there are thousands of digital currencies. It's like exploring a new frontier. Exciting but uncertain. Some see a future currency, others a speculative opportunity. Pro tip on cryptocurrency: it can be a volatile investment. Only invest what you can afford to lose and do thorough research. By understanding these investment types, you're laying the foundation for financial success. Diversifying across them can create a resilient and potentially rewarding investment portfolio. In the next section, we'll explore how to set specific investment goals. It's your roadmap to turning financial dreams into reality. Stay with me here on Penny Street Journal as we continue this exciting journey towards financial empowerment. To further explore these options, make sure to consult with a financial advisor or use reliable resources online. The right investment type depends on your goals, risk tolerance, and financial situation. Now that we've mapped out the landscape of investment types, let's navigate to our next destination: setting investment goals. As we journey into the realm of investments, let's start with one of the most essential tools in our toolkit: our investment goals. Knowing what you want to achieve is like having a destination in your GPS. It guides every turn and decision. Short-term goals, up to 3 years. These are your immediate targets, like saving for a vacation or emergency fund. Imagine you want to save $3,000 for a dream vacation next year. By putting this into a high-yield savings account with a 2% interest rate, you'll earn $60 in interest. It's safe, and it's moving you towards that relaxing beach. Medium-term goals, 3 to 10 years. Planning for a child's education or a down payment on a house? Medium-term goals require a balanced approach. Suppose you want to save $20,000 for a down payment in 5 years. A mixture of bonds and some growth stocks could grow your $15,000 investment to reach your target, with potential gains of 5% annually. Long-term goals, more than 10 years. Think retirement or leaving a legacy. These goals allow for more risk and potential growth. If you start with $50,000 and invest in a diversified portfolio of stocks and bonds, aiming for a 6% annual return, in 20 years, you could have over $160,000. That's a comfortable cushion for retirement or helping the next generation. Pro tip: align your investments with your timeline. Short-term goals need safety, while long-term goals can afford to aim for growth. It's like choosing the right vehicle for the journey. A bike for a quick trip to the store, a car for a weekend getaway, and a plane for a cross-country adventure. Setting clear and realistic goals is the compass that will guide your investment journey. It leads you in the right direction, helping you choose the best paths and avoid unnecessary detours. With our goals now set, we're ready to explore risk management and diversification, ensuring we're prepared for the twists and turns ahead. Now that our investment goals are set, we must prepare for the road ahead. That's where risk management and diversification come in, our safeguards against unexpected events and obstacles. Understanding risk. Not all investments are created equal. Some might promise high returns, but come with a significant chance of loss. Others might be slow and steady. Think of it like weather patterns. If you invest everything in one high-risk stock, like a thunderstorm, you might face a downfall. But balancing with stable bonds, calm, cloudy weather, can provide shelter. Diversification. It's a golden rule. Spread your money across different investments, industries, and even countries. Imagine if you held stocks only in the tech industry, and then a tech crash occurred. Your entire portfolio would suffer. But if you had diversified into healthcare, finance, and utilities, you'd still have steady ground, even if tech was shaken. Risk tolerance. Know yourself and your financial situation. Can you endure a significant market dip without panicking? For example, if you're investing for retirement 20 years away, you might have a higher tolerance for risk and can aim for higher growth. But if you'll need the money in 5 years, consider a more conservative approach. Pro tip: review your risk and diversification regularly. Markets change, and so do personal circumstances. It's like getting a regular checkup for your financial health. Avoiding unnecessary risks. Always do your homework before investing. Understand what you're getting into and whether it aligns with your goals and risk tolerance. Just like you wouldn't buy a car without knowing its history, don't invest in something without understanding its past performance, management team, and how it fits into your overall strategy. And there we have it, a sound strategy for controlling risk and diversification, helping you navigate the investment landscape with confidence and poise. Next, let's talk about how you can save on investment costs and fees, ensuring that more of your money stays in your pocket. The world of investing can be an exciting one, full of potential gains. But what about the costs? Let's take a careful look at the fees and expenses that can impact your investment returns. Transaction costs. Every time you buy or sell an investment, you may incur a fee. Imagine selling a stock and losing $10 in fees. It might not sound like much, but if you trade often, it adds up. Think of it as a small leak in a boat. One drop won't sink you, but many might. Fund management fees. Mutual funds and ETFs often come with management fees, known as the expense ratio. If you invest $10,000 in a fund with a 1% expense ratio, you'll pay $100 every year in fees. That could mean thousands of dollars over the years, money that's not working for you. Advisory fees. If you use a financial advisor, you'll likely pay for their expertise. Imagine having a personal trainer at the gym. It might help you get into shape faster, but it comes at a cost. Make sure you understand what you're paying for and how it benefits you. Pro tip: look for low-cost index funds or robo-advisors that provide guidance without the high fees. It's like choosing a fuel-efficient car. It gets you where you want to go without draining your wallet. Taxes. Depending on your location and investment type, taxes can also eat into your returns. It's essential to consult a tax professional to understand your specific situation. Investing without considering taxes can be like sailing without a compass. You might end up lost. As we wrap up this section, remember that understanding and controlling costs is a crucial part of your investment strategy. It helps ensure that more of your money stays invested, working for you. With these insights into the costs and fees, you are now equipped to make smarter investment choices. Next, let's look at how all of these pieces come together to form a complete investment strategy. We've journeyed together through the world of investing, discovering key principles to guide us on the path to financial freedom. Let's take a moment to recap what we've learned. Understanding different investment types, whether short, medium, or long-term, aligning investments with your goals is crucial. Setting investment goals. By knowing your destination, you can map the best path to get there. Controlling risk management and diversification. Building a well-balanced portfolio helps you weather the storms of the market. Saving on investment costs and fees. Knowing the costs and finding ways to minimize them puts more of your money to work. Investing doesn't have to be a maze filled with jargon and complexity. It's a journey, and like any journey, it begins with that first step. Pro tip: don't let fear or uncertainty hold you back. Start small if you need to, and learn as you grow. Just as a small seed can grow into a mighty tree, your small investments can grow into a secure future. Subscribe to the Penny Street Journal and stay tuned for more insights into investments, personal finance management, and market trends. We're here to guide you every step of the way, turning confusion into clarity and fear into financial freedom. Remember, it's never too late to take control of your financial future. The road to security, independence, and growth starts with a single step. Why not take that step today? Thank you for being with us on Penny Street Journal. Together, we'll help you build a future you can count on. See you next time.